afternoon. It's BizTech's Asian Midday Market Watch on Monday, the 30th of September. My co-host today is Samantha Voon, and our guest will be Tim Waterer from KCM Trade in Australia. We'll bring Tim in just a moment, but let's start with the summary of what happened on Friday night before we get to what is a pretty frisky day in Asia today, particularly on stock markets. On Friday, the blue chip Dow Jones industrial average closed at a record high. That was mostly stoked by benign PCE data, which is one of the Federal Reserve's favourite measures of inflation. It actually boosted small cap stocks as well. However, the technology heavy Nasdaq slipped for the day slightly, and also the S&P 500 edged slightly lower. So it was mostly within the Dow Jones and the small caps that we saw that aggressive market reaction. The Dow Jones rose 138 points, or 0.33%, to 42,313. The S&P 500, in contrast, lost just over 7 points, or 0.13%, falling to 5,738.17. And the tech-heavy Nasdaq lost 70.7 points, or around 0.4%. Finishing at 18,119.59. In Asia today, futures on all three of those indexes almost unchanged, despite some extremely wild moves in Asian stock markets themselves. On currency markets, the US PCE data inspired quite a bit of wide range trading, quite a bit of intraday volatility, but ultimately most major currencies, with the exception of the dollar yen, settled almost unchanged. Euro dollar closed 0.11% lower at 111.65, and it's around there this morning. Dollar yen, in contrast, plummeted by more than 1.8% to 142.20 after a new PM was elected by the LDP, and that spurred fears of more interest rate hikes from the Bank of Japan. In contrast, the dollar index closed just 0.15% lower at 100.42, and it's not far off there this morning. Gold fell 0.5% to $2,658 an ounce. And with that, Sam, over to you for today's crazy moves in Asian stock markets.
Thank you, Jeff. All right, so we have in Japan, the Nikkei 225 down 4.84%. In Shanghai, the composite is up 6.48%. And in Hong Kong, the Hang Seng is up 3.43%. In Australia, the XX 200 is up 0.69%. And over in Korea, the Kospi is down 1.21%. Singapore, the STI is up 0.14%, and in Kuala Lumpur, it is down 0.37%. Now, Jeff, back to you.
Thank you, Sam. Let's bring in Tim Waterer, our guest today. Tim is the Chief Market Analyst at KCM Trade, and he's coming to us from Sydney today. Tim, welcome to the show, mate. Always a pleasure.
Thanks very much, Jeff. Good to see you and Sam. Happy Monday.
Always a happy Monday. Tim, we must start the show with what's going on in Asian stock markets today. It's a tale of two halves. Japan is over 4% lower. Meanwhile, Shanghai and also Hong Kong have climbed somewhere around 4%. And that is despite the fact that we saw some pretty ugly PMI data from China today. Can you walk us through what's going on there first?
Yeah, that's right. Contrasting fortunes, isn't it? Certainly not one-way traffic today. In terms of Japan, what we're seeing, I think it's a twofold effect there. Obviously, Toshiba got the nod there. Looks set to become the next PM, and considered more hawkish when it comes to rates, as you alluded to, than Takahiki, which this time Friday we're thinking he might get through. So a readjustment in markets, and that's the fact that there could be that more hawkish stance on rates that's hurting the Nikkei today, and also, as you said, we're seeing the dollar yen really tail off, now trading around the 142 level. So that stronger yen having a negative impact on the Japanese export segment of the market today. And that's why they've headed south. And by contrast, as you say, the Hang Seng, the CSI 300, they're all sort of, looking in good shape today, despite the softer raft of numbers we saw domestically. I think, Chinese stocks, Hong Kong, and also by extension other Asian markets, including Australia, they've got this tailwind still coming from those stimulus measures announced last week. It's pretty impressive what we've seen from Chinese equities. And I think from a valuation perspective, even, factoring in the gains last week and today, on a P/E ratio basis, it's still looking cheaper, if we put it that way, compared to, say, the S&P 500 or another competing market such as India. So I think that's why we've seen a continuation of buying demand on China while there's that good news story happening.
And I'm looking at the calendar just as you were speaking, and I was just taking a double take at the Japanese industrial production numbers that came out this morning, which made horrific reading, down 4.9% year on year preliminary. Do you think that's also having an impact on Tokyo equities today?
Yeah, certainly not good news there on the macro front. They had some better retail sales figures recently, so there's a little bit of an offsetting effect there. But yeah, it's always, I guess, a concern for investors, both domestic in Japan and foreign investors, when you have this situation where they're in a rate hiking cycle, albeit at the early stages at this point. At the same time as we're getting some pretty disappointing macro numbers, so that can put central banks in a bit of a bind. It remains to be seen whether we do see another rate hike by the BOJ by year end. I think it's a toss up at this stage. A lot going on there at the moment, but yeah, right now a lot of negative news flows on Japan, and certainly come a long way down from the highs we saw just a few months ago. Really.
Well, let's just stay on China for just a moment before Sam comes in. We've asked this for every guest last week. We've seen a raft of measures coming out of China by the government and the PBOC, et cetera, to try and lift the China, particularly the domestic economy, out of its melees. Do you think China's done enough, or is it too soon to say?
The jury's still out at the moment. I mean, I think it's certainly a positive step. This is the most proactive set of measures I've seen, since they've come out of the COVID reopening phase. So I think, a combination of the cut to the RRR, the reduction in existing mortgage, payments in terms of the percentage, and also reduced, down payment figures. So I think, that does free up some more disposable income. Now, whether the consumer chooses to save that or spend that, that's the question we have to wait and see. I think, according to the economics textbooks, if you want to sort of stimulate, domestic spending, then maybe fiscal measures are the more efficient way to arrive at that outcome. Now, China has sort of, erred away from that so far. So, I mean, I think for myself, I'd like to see some more efforts on the fiscal front, which I think is a better transmission mechanism to lift retail sales and in turn CPI, and start pushing higher some of these, the service sector, manufacturing sector. They're sort of still, stuck around that level. Yes, I'd like to see more fiscal measures. Now, that's not all, there is a negative to that as well from the PBOC's point of view, of course, which is that, they can rack up debt. So that's why they've taken a different course of action to some, Western central banks in terms of trying to get the economy going. So yeah, a good step in the right direction. Markets, I think, it's a fair move higher that we've seen based on the stimulus measures. But does it have the longevity? I think it needs to be supplemented with fiscal action.
So Tim, I want to move to the currency markets, right? Now, the dollar index is holding above 100, but it's looking weaker on the charts. So what are your outlooks for the dollar?
Yeah, that's right. The dollar index, so keeping its head above water. If we use that 100 level as the psychological watermark there in terms of where we can measure its weakness on. So yeah, about 100.3, 100.4. So it has come under a lot of pressure in the aftermath of that FOMC meeting. Right now, market expectations are that we could see another 75 basis cuts from the Fed between now and year end. That could be in the form of another 50 cut in November plus 25 in December, or some combination of those. Now, if those expectations hold, we could see the dollar index dip below 100. We've seen it lose ground against the euro, against the Chinese currency and of course the yen, that we've seen on the chart today. So yeah, dollar definitely under pressure, but I think there's always a chance of a rebound. So right now it's a very dovish expectation inbuilt into currency market pricing. If we saw some stronger macro data come out on the calendar, that could cause a bit of scaling back of what we could see from the Fed. So I don't think it's necessarily all one-way traffic lower for the dollar at this point in time, but certainly under pressure whilst the Fed remains on track for that, maybe 75 basis points between now and year end.
Well, looking at commodities, when you're speaking about one-way traffic, we are seeing some divergences there. Oil had a pretty tough week last week on the pricing front, and that's despite a US dollar that is weakening overall. Yet gold, for example, remains almost at its all-time highs and seems to be immune to moves in either interest rates or dollars at the moment. What do you believe is driving this divergence?
Yeah, that's right. Gold's been the one to cash in on that US dollar weakness, more so than oil at this stage of the game. So yeah, gold's doing well based on lower interest rates, reducing opportunity costs for gold, and also becoming cheaper as that US dollar weakens. So a double-pronged effect there for gold at the moment. That's why we're seeing it still around these all-time highs at the moment. Oil, a bit of a different story there. I got a brief pop from the Chinese stimulus, but it hasn't maintained that, and I think that's quite telling at the moment. So that's despite the hot zones we have in the world at the moment, which could impact supply going forward, depending on how things pan out there. So I think the oil market's still excluding the risk premium at the moment that perhaps should be priced in at the moment. And more a focus on, I guess, of course, what's happening on the Saudi Arabia front. I mean, it looks like they're a bit more willing to move on their targeted oil levels to try and just basically ramp up production as we head towards year end. So oil market more fixated on an oversupply situation, heading, to round out 2024, heading into 2025. That's putting downward pressure on the price. Not so with gold. We don't have those sorts of concerns at the moment. I think, gold could have more upside to come, once again, predicated on further cuts from the Fed heading into 2025.
Mm-hmm. So, Tim, despite being on holiday all week for in China from tomorrow, right, there are still some heavyweight data releases elsewhere. So what's on your radar, Tim?
Yeah, that's right. A big week on the economic calendar. Last week was all about, I guess, the inflation figures, the core PCE that Jeff talked about, whereas this week we look at the other side of the Fed's mandate, which is the labour market and, jobs market stability. So we've got a number of key readings this week. So the job openings data, ADP, so private employment numbers around midweek. And then the big one will be the non-farm payrolls figures on Friday. So I think that result could really play into how markets price the amount of cuts between now and year end by the Fed. So we're looking at, for the non-farm payrolls, a figure around about 145,000 jobs created for September. So I think that would be sort of a pass score there, with the unemployment rate staying around 4.2. Now, the Federal Reserve think that'll go to around 4.4% by year end. So the Fed are counting on continued labour market weakness to then go ahead with further cuts. So, but look, a couple of scenarios that could play out. If we saw a particularly weak NFP figure on Friday, then I think we'll see the dovish Fed expectations solidify, maybe further downside for the dollar, upside for gold potentially, and also equities. But conversely, if we did see an upside surprise, there could be some questions about whether the Fed were maybe a bit too much on the front foot with that 50 basis point cut. Mm-hmm. So I think there's a lot riding on that jobs number this Friday. I think that's what the market's really going to focus on, and could cause a bit of volatility, I think, when that number comes out around 8:30 a.m. on New York on Friday morning.
We're just not going to get bored in 2024, are we? That's for sure, especially Q4. Tim, thanks for being on the show today. Always a pleasure.
Thank you, Jeff. Thanks, Sam. I enjoyed it. Thanks very much.
We've been speaking to Tim Waterer, Chief Market Analyst at KCM Trade, coming to us today from Sydney in Australia. And this has been BizTech's Asian Midday Market Watch. Be sure to tune in each day at 1 p.m. on weekdays for the latest market updates. I'm Jeffery Halley.
And I'm Samantha Voon.
And this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. You can also see it and hear it with our syndication partners, TV stations, radio stations, and websites. Remember to like and subscribe, and thanks so much for tuning in today.